Okay, so now it's time to ask the question, why are bonds risky? Now, in previous recordings, I have said that bonds are low risk, but that doesn't mean that there's no risk associated with holding bonds. There's certainly different elements of risk, and in this video, we're going to discuss the sources of risk when you purchase and own a bond. Now, before we do that, let's just have a think again about why bonds are relatively safe, which does not mean that they don't have any risk, why they're relatively safe compared to, say, shares. With shares, I've seen it myself over numerous years, shares which have dropped in value to zero. So the company's basically gone bust, and the share value just hits zero, you lose all of your money. Of course, that doesn't happen frequently. Most companies in Australia have been around for decades, and so many shares are very safe. But even with those shares, I have seen companies just after the GFC halve in value. So the Australian bank shares, for example, they halved in value after the global financial crisis in 2008, 2009. Of course, the share price did come up after that, but there was a big loss there. And so anyone who had to cash in, maybe was forced to cash in at that point when bank share prices had halved in value. Maybe they had to cash in because they had bank loans, which they'd used to purchase the shares, and maybe those loans had been called in by the banks. So there's a lot of different ways people can lose money in the share market. Company can go bust. You can lose all of your investment. Share price may drop and you may be forced to sell, or the share price may drop and it may take 10, 15 years for the share price to actually return to its original value, which in a sense is kind of a lost opportunity cost. You could have had that money in a safer asset and just watched it grow over that 10, 15-year period. So shares, you can lose all of your money. Compare that to bonds. It's very difficult to lose all of your money if you are investing in bonds. The only way that you can do that is if the government or the company that you have loaned the money to when you bought the bond refuses to repay the principal at maturity, either refuses to or simply can't. And if we're talking about things like Australian government bonds, US government bonds, or bonds from big Australian companies such as ANZ, Commonwealth Bank, Woodside, BHP, it's very unlikely that those companies would get themselves into that situation. Not impossible, but very unlikely that they would get themselves into a situation where they simply can't repay the principal of the loan, that is the face value of the bond, at the maturity of the bond. Okay, so that's the way that I like to think of bonds being a relatively safer asset than shares. Okay, also, I guess another way of thinking about it in terms of the riskiness of shares versus bonds is many Australian shares will pay semi-annual dividend payments. If the economy goes into a recession, then we have seen in recent decades companies just not pay a particular dividend. So if the dividend is due every 6 months, the dividend may have been cut substantially. As the economy moves into a recession and the company's profits fall as a result. So the dividend may be cut, or it may be just not paid at all. There's plenty of examples of that happening. So you do face a little bit of dividend risk. But with bonds, the coupon payment is being committed to. It doesn't matter the state of the economy, whether the economy is in recession or not. The lender has committed to pay that coupon payment. And the only way they would not is if they were physically unable to do so. So coupon payments, more reliable than dividend payments. Okay, so that said, I guess the other asset class. So let's ask ourselves the question, what are the three main asset classes? Shares, bonds, and real estate. Now, the thing that we need to understand about real estate is that real estate is not a liquid asset market. So what that means is If you want to invest your money into shares or bonds, you can sell those shares and bonds and get your money back in about 2 to 3 to 4 days. Compare that with real estate. You have to advertise the property. It'll typically take weeks, if not months, to sell the property. And then it takes time for that, the proceeds of the sale to actually hit your bank account. So I've sold a couple of houses myself, and it can take months to get the money. Some people, it can take up to a year or more to sell their house at the price they want. So in that sense, real estate markets are not as liquid as stock markets and bond markets. By liquid, I mean, can you move your money in and out of those markets quickly? Bond markets, share markets, certainly liquid. Real estate, not so much. So let's just imagine now that you are an international investor. Say you're a Canadian fund manager and you've got $10 billion to invest, and you're looking at Australia to invest some of this money in. But you want to retain the liquidity of your portfolio. You want to make sure that your investments are liquid. What sort of assets will you go into? You're more likely to go into shares and bonds rather than real estate. I'm not saying that international investors do not invest in real estate. Of course they do. We have plenty of foreigners investing in Australian property. What I'm saying, however, is that more money is invested in stocks and bonds by international investors. And one of the things that international investors really need to be careful of is movements in the Australian dollar. So let's just imagine that some sort of you had money invested in Australia, you were a Canadian investor, you had money invested in Australia, and there was some adverse macroeconomic shock that hit the Australian economy. And you believed that that was going to cause a slow depreciation of the Australian dollar over the next year. And you've got your money invested in Australian assets denominated in Australian dollars, and you believe the Australian dollar exchange rate is going to decline. You'll want to get your money out before the exchange rate declines too much, and maybe move money into a safer currency in another country. See the problem? If you've got your money invested in real estate, it's going to take you time to move that money offshore out of Australia into another currency. Whereas stocks and bonds, you can do that very quickly. As I said, you can get your money in the matter of days. Compare that to months that it takes to sell real estate. So very soon, the next couple of topics 5 and 6, we'll be talking about investment money moving around the world and how that works. And we'll be thinking about these big global investors and what happens when they invest money in Australia or take money out of Australia, or invest money in the US and take money out of the US. I just want you to keep in mind that a lot of this money that does move between countries moves in and out of countries through bond markets and stock markets, not so much real estate markets. So if you're an international investor in Canada, you'll devote far more of your portfolio to Australian stocks and bonds than you would real estate, for the reasons that I've given. Okay, so that's a little bit of information about bonds and in what sense bonds are less risky than shares, and why bonds are more liquid than real estate. So bonds are still risky, however. So let's just go through 3 main sources of this risk. First of all, we'll revisit this equation. The nominal exchange rate equals the nominal interest rate equals the real interest rate plus the inflation rate. So hopefully that equation should make sense to you now. So in terms of you holding a pile of bonds, let's say $1 billion worth of bonds, where does the risk come from? The first is default risk, and we've already spoken about that. So that is the coupon payment may not be made or only partially paid, and/or the face value of the bond may not be repaid either in full or partially at the maturity of the bond. So in terms of the lender, so you're holding the bond, so you're the lender. In terms of the borrower, which is the seller of the bond or the issuer of the bond, so in terms of the borrower, default could come from two sources: not paying the coupon payment or not paying the face value of the bond at maturity. The second source is inflation risk. Okay, and there's two ways to actually think about this. Inflation risk occurs when higher than expected inflation reduces the real value of the yearly coupon payment and the face value of the bond. So let's just imagine you expected an inflation rate of 3%, and all of a sudden it jumps to 10%. You're holding this bond expecting 3% inflation, but now the inflation rate surged. So when you get your money back at the, let's say when the bond matures, the price level is far higher than when you negotiated the loan initially. The price level is far higher because of the higher inflation rate. That means the purchasing power of your money has actually fallen, and the purchasing power of the coupon payment will also fall as those coupon payments are paid at, say, 6 monthly intervals. Let's look at this inflation risk from a slightly different perspective, though. From the perspective of this equation up here, let's just use some very easy to manipulate numbers. Let's imagine that the real interest rate is 5% and the inflation rate is also 5%. That is, the expected inflation rate's 5%. So the nominal interest rate's 10%. Okay, so you've entered into a loan, you are lending money. You're lending at a nominal interest rate of 10%. Over the course of that loan, you expect the inflation rate to be 5%, so you expect your real interest rate to be 5% as well. That's the situation at the moment. Now we come back down here, and higher than expected inflation occurs. So you expected 5% inflation, but now the actual inflation rate turns out to be higher than expected. So you've loaned money at 10%, expecting inflation of 5% and a real interest rate that is a real return of 5%, but now the inflation rate jumps up to, let's say, 8%. That means with an inflation rate of 8% and a nominal interest rate of 10% on these bonds, you now only get a real interest rate of 2%. So this higher than expected inflation of 8% has eaten up most of the return that you get, most of your nominal interest rate, implying that the real interest rate is very, very low at 2%. So you can think of inflation risk in two ways. Inflation risk means inflation is higher than you expected when you made the loan. You can think about it in two ways. The first way is that when you get paid the coupon payments and the face value of the bond back at maturity, the money you get back has less purchasing power than you expected because the inflation rate turned out to be higher than expected. Rather than 5%, the inflation rate turned out to be 8%. That's one way of looking at it. The other way of looking at it is that higher than expected inflation simply lowers this real interest rate down to, say, 2% in the example that I gave. Okay, the final source of risk is interest rate risk. Now, we know that there is an inverse relationship between interest rates and bond prices. Now, the way bond markets work is sometimes there will be just an across-the-board increase in interest rates in bond markets. That increase in interest rates could come from strong demand for loanable funds, which will push interest rates up. It could come from a decreased supply of loanable funds, which will push interest rates up. Either way, we're considering interest rates increasing. Now, we know from this topic so far that if interest rates begin to rise in bond markets, then bond prices must be falling. Now, that's not going to be too much of a problem if you want to hold your bonds to maturity. It doesn't matter what happens to bond prices over the course of their life if you expect to hold those bonds to maturity, because at maturity, you'll get the face value of the bond back. And in this example, we're now assuming that inflation is not higher. It's just the same. The expected inflation rate's just the same as it was when you entered the loan agreement. So we're not considering in interest rate risk, we're not assuming that the inflation rate's higher. We're assuming that interest rates have just increased for some other reason. Maybe, as I said, decrease in the supply of loanable funds or an increase in demand. Either way, when those interest rates increase, and I actually just step back, I'm separating out these two effects, inflation risk and interest rate risk. That's why I said under interest rate risk, let's not assume that inflation has increased. Okay, because if you do that, if you assume that interest rates are rising because inflation is higher, then it complicates this risk, this source of risk. Okay, so I don't want to do that at this stage. So we'll keep it nice and simple and just assume that interest rates have increased in bond markets, but it's not because inflation has increased for any, it's not because inflation has increased. So interest rates have gone up. We know that that decreases bond prices. And the problem then comes if you need to sell your bonds prior to maturity, because then you'll incur a capital loss because you'll be selling at a much lower bond price because interest rates have increased. Now, what happens over the life of a bond is bond prices go up and down. They fluctuate inversely with interest rates. But as you get closer and closer to maturity, the bond price gets closer and closer to its capital value. So what I'm getting at is, let's just imagine we have a 5-year bond, and that the face value of that bond is $1 million. It is possible 4 years from maturity that that bond may actually be bought and sold for, say, 1.2 million, which would imply a much lower interest rate than when the bond was initially issued. Assuming that the bond was initially issued or sold at its close to its face value of $1 million, and then it was due to be redeemed 5 years later for $1 million, its face value. Let's just assume that after about 1 year, bond prices have increased to 1.2 million. So 4 years from maturity, the bond price is 1.2 million. That would imply that bond yields have been going down, which is quite possible. But let me ask you this question. Would it be possible for a bond to sell at the same bond to sell for $1.2 million a week before maturity? I'd say virtually impossible. Why? Because what you'd be doing is, if you could buy a bond that has a face value of $1 million for $1.2 million a week before maturity, you'd be throwing money down the drain, because you'd be buying it for 1.2, holding it for a week, and then when it matures, only getting $1 million back. You'd have to be out of your mind to buy that bond for that price so close to maturity. It's almost a guaranteed capital loss of $200,000. So even though bond prices can fluctuate quite wildly, as they get closer and closer to the maturity date, they sort of gravitate toward, the market price of those bonds gravitates towards their face value. So while bonds that are fairly young, the prices can fluctuate quite dramatically, bonds that are older, that is closer to their maturity date, the fluctuations in those prices are much, much less because of the reason that I just gave you. There's no way someone is going to sell a buy a $1 million bond for $1.2 million 7 days from maturity. Similarly, there's no way someone is going to sell, excuse me, a $1 million bond 7 days from maturity for $800,000. Why would you sell a bond that you can redeem for $1 million 7 days from now for $800,000 7 days out? Once again, you'd have to be out of your mind. So all of that sort of, I think, should help you understand the different sources of risk. So we've got default risk, inflation risk, which affects default risk means that you just don't get the money you're promised. Inflation risk means that the returns on the bond, that is the coupon payment and the face value of the bond, have less purchasing power when inflation is higher than expected. And interest rate risk, that involves incurring capital losses on the sale of bonds if you sell them prior to maturity. There is one other source of risk that I'll actually add to this list. It's exchange rate risk, and I've already mentioned that. Exchange rate risk. The risk there is this. You're a Canadian investor, you've got $10 billion to invest. You invest $1 billion of that money in Australian bonds. Doesn't matter whether they're government bonds, corporate bonds, they're just bonds. And those bonds have a yield to maturity that you've purchased of, let's say, 7 years. So they're 10-year bonds, but you've purchased them after they've been on the market for 3 years. So they've had numerous other owners. They've been bought and sold quite a few times, but you've purchased them 3 years after they've been issued. So they've got 7 years to maturity. And all of a sudden, something happens and the Australian dollar collapses overnight by 20%. Doesn't matter what could cause the source of that depreciation. And we could even consider depreciations of the Australian dollar that aren't as dramatic as that. Even 5% would cause you exchange rate risk. But let's just say the Australian dollar dropped by 20% and it stays there at this much lower level. Well, as being that Canadian investor that's invested $1 billion into Australian bonds, you've just lost 20% of your capital. Now, in the past, I have had people say to me, well, can't you just hold the bonds until the Australian dollar comes back up? Well, what if it doesn't ever appreciate back up? What if over the next 10 years, it just continues to decline? You just don't know. And one of the most difficult variables to forecast in macroeconomics is the exchange rate. It's a variable that's virtually impossible to forecast. I won't go into the reasons why. That's getting too far from the course. So exchange rate risk is a real concern. Now, of course, you can hedge against these different risks, but that's not free. That costs you money. So we've got default risk, inflation risk, interest rate risk, and exchange rate risk. Now what I'm going to do is modify this top equation, extend it a little bit to add in right at the end and a risk premium. So now this nominal interest rate can be driven by changes in the real interest rate, changes in the expected inflation rate, and changes in the risk premium. So for example, as a Canadian investor, you may be concerned about the exchange rate risk associated with holding a bond, an Australian bond. That means you're concerned about the volatility of the Australian dollar, particularly the possibility of the Australian dollar depreciating. That might mean that before you lend money to an Australian, to the Australian government or an Australian company, you may need an additional 2% in terms of nominal interest rates in the form of a risk premium before you'll lend that money. And you may be worried about the Australian company that you're lending to. That company may have dropped from a AAA credit rating down to an A credit rating. And so that then means you face more default risk. So you may need to be compensated for that by an additional 1% built into this risk premium component as well. What I'm trying to get at here is that we've got default risk, inflation risk, interest rate risk, and exchange rate risk. And lenders will need to be compensated for those four sources of risk by a higher nominal interest rate in percentage terms. And so the risk premium, think of that in terms of an additional percentage return or an additional return expressed as a percentage of the original investment that is built into this nominal interest rate. So real interest rates might be 3% in the US, the inflation rate might be 3%, and the US may be perceived by international lenders as having very low risk. So they may need only a 1% risk premium to lend to the American government or American companies. So therefore we've got 3%, 3% and 1% for the US. In contrast, Australia could have the same 3% real interest rate, the same 3% expected inflation rate, but now the risk premium might be 2.5%. Why? Because the Australian dollar is more volatile, and we might have international lenders believing that there's more inflation risk in Australia. It doesn't matter where this 2% risk premium comes from. It could be coming from any one of the four sources of risk. The point is it's higher in Australia. So then in Australia, we've got 3%, 3%, 2.5%. We've got an 8.5% nominal interest rate on bonds compared to 7% in America. So this shows you where variations in bond yields across countries could come from. And so we'll be looking at some actual bond yields later in the course, and it's really handy to have in mind this bottom equation. So if we're looking at a situation where bond yields in Greece are so much higher than in the US, then this equation gives us insights into where the difference in bond yields in Greece and the US may be coming from. They could be coming from just pure differences in the real interest rates, which is unlikely. They could be coming from differences in the inflation rate in the two countries, quite likely, or differences in the risk premiums in the two countries. And in the case of Greece versus the US, highly likely. Okay, so that's how we're going to be using this equation, and we will be coming back to this equation to sort of deconstruct actual interest rates on bonds a little bit later on in the course. Okay, so we'll be actually looking at actual bond yield data, particularly comparing them across countries and using this equation to figure out where the differences in actual bond yields may be coming from.